I'm going to turn it over to Brenda Foster, who is from, let me get it right, First Western Bank and Trust of Minot, North Dakota. So.
Thank you, George. And if it's okay, I'll just sit right here, and I think I can see everyone just fine. And yes, I am from First Western Bank and Trust in Minot, North Dakota, and we do have locations in North Dakota, South Dakota, and Minnesota. And I really appreciate the opportunity to be here with all of you and commend Stephen, Siddharth, and Alexander and your teams on the papers that you have put together. And I can comment just a little bit on the math that was talked about. If I ask my lenders to look at those formulas and calculations, I may not have lenders left at the end of the day. So very, very nice job, and it's all very relevant information as we talk today about assessing credit risk. And I give you just a little bit of my background because as Jeff is a passionate community banker, so am I. I've spent my 42-year career at the same bank in community banking and very passionate about community banks and what we're able to do in partnership with our communities and our customers, regulators, our whole team. And so some of my comments today will definitely be geared to community banking. So building relationships as a community banker is extremely important, and as you get to know the businesses that you're working with or your consumers, it doesn't always fit a box. And that's what I'm passionate and why I like community banking, because we don't need everything and everyone to be fitting in a box. We look at being a community partner and a partner with our customers, because when your community does well, your bank does well. And it's the right thing to do. We want to be part of the success of a community. Models and statistics give us a lot of data, and that's extremely important. We can never discount the data, but we do have to be able to react to each individual circumstance, each individual request. Because although maybe requests are similar, they're not exactly the same, and we can't categorize everyone, no matter what region that they're in the same. We can't paint it with the broad stroke. Character. We cannot dismiss the character of an individual, because that does help us sometimes tip our decision one way or another. And I know you can't always quantify that, but there are situations that maybe you are wondering, should you approve this loan or not? But as you get to know a little bit more about your borrower and the circumstances that they have, character does need to come into play. So as we talk about the first paper, internal loan risk ratings, and I'm very passionate about community banking. When I see our lenders become very passionate about community banking, and sometimes they're extremely passionate about the credit that they are presenting. That's a good thing. We want that partnership. So as lenders present a credit that they've been working really hard on, accumulating the data and information necessary to put together to bring to credit committee, and they do believe in what they're doing, and I want them to believe in what they're presenting. And it is maybe human nature to be very passionate about that presentation, and they're there because they believe in it. And that's a good thing. And so to mitigate maybe their over excitement about a credit, we mitigate that by a strong internal risk rating system, which over my career has evolved. It maybe wasn't as strong as it could have been several years ago, but as we work in partnership with our regulators and understand what you're looking for, we have adapted and adopted a stronger risk rating system. And so along with our strong internal risk rating system, our credit committee asks the tough questions. We have good interaction in our credit committee. And so it does assist in that lender maybe taking a little bit of a step back in regard to the passion they have for that particular credit. And during the analysis phase, not only does that involve a lender, but it involves our credit analysts, our credit officers, and loan committee. So there are many individuals reviewing that particular credit. And so as as we have learned every day, it's about assessing risk, no matter what we're doing. If it's the loan side, deposit side, vendors, we're always assessing risk. And bankers need to do their best to make sure that when they're bringing something to committee and assessing a risk, that they've got the data necessary to answer all questions. And sometimes that takes a little while with your borrower. You have to educate them as to what we need in order to make a very good decision. The thought about loan ratings being stronger for loans with higher utilization rates, which would require larger loan provisions, and banks would have incentive to avoid maybe downgrading those risk ratings. I don't believe that this level of thinking to be the case on our frontline lending officer level. You know, as you go up the chain to your senior managers, of course, they may be thinking about that, but when a frontline lender brings in a loan, they're not thinking about that loan loss. They are thinking about the deal in front of them. How can I help my customer? Does it make sense for the bank to be involved in that? So lenders typically are not considering loan loss provisions when working on a single credit or establishing a new relationship. That's not the top of mind that they have at that particular time. So the question, do banks systemically inflate loan ratings? I would say my answer is no, for the most part. Is it done, you know, not on purpose at times? Certainly that could be the case. But overall, I would say my answer would have to be no, because loans do go through underwriting and we need to have the ability to maintain an infrastructure that mitigates risk. And so with all of the mitigating factors that a lender goes through in order to come to a potential approval, I would say that it's very well vetted. And there's always a lot of good active discussion. Can supervision mitigate ratings, inflation, and consequences? Yes, I think as we work together, banks and regulators, and I can say over my career, I have seen the pendulum swing, and which is a good thing. I really do feel our regulators are a partner. They want to see the banks do well. They make good recommendations. If we sometimes agree to disagree, that's okay, but we hear each other. And so today, I think the relationships that we have with regulators and many in this room are very good. Robust discussions that make everybody better, and that's our end goal. Community banks need to have the ability to create and maintain internal infrastructure that helps to mitigate risk while continuing to fulfill our mission for the communities that we serve. Because small business is really, our bank has grown up with small business. That's the reason for our success. It's the reason our communities are successful. And we need to be able to pivot and maybe do a deal that could go either way. But if you know the character and you know the full circumstance, it makes your community better. And you're giving that entrepreneur a chance. And some of the programs that we're hearing about through SBA, those are things that help us to mitigate risk, and they're extremely important. And I'll talk a little bit more. I'm going to jump to credit. Can credit rating affect credit risk? Absolutely. Higher credit ratings may see better rates and or more borrowing capacity, and FICO scores are very important. And we have experienced from the bank side, yes, consumers, you know, depending on what is happening with their FICO score, it definitely has an impact on them, positive or negative, but it also has had a negative effect on our bank. As we rely on FICO scores, we have tracked in some instances that loans that were approved based on a FICO score, and there's more things that go into your approval than the FICO score, but if you are looking at that and making decisions based on an inaccurate FICO score, it has created some loss in our institution. Now, not large losses, but we have tracked it back to inaccurate FICO scores. And so the prominence of the FICO score in lending decisions cannot be overstated. We need a system that is accurate. And it's widely known that the FICO scoring system has errors, and so, you know, who holds them accountable? The credit bureau is one tool that in our toolbox when underwriting, bankers depend on that being accurate. If you have a bank that takes online applications, you're relying heavily on that accuracy of the credit bureau to underwrite a loan. If no one's monitoring credit reporting, there will be errors. With CECL coming into play, data now is being tracked, and I think as we move forward, we will have better data on the FICO scores. Community bankers build relationships with customers, which assist in identifying errors in the credit bureau. And as you have relationships with your customers, you can probably find out a little bit more information and identify why that is an error and make a decision that is outside of what that FICO score is telling you. Speaking a little bit on the regulatory risk perception in small business lending, community banks monitor risks in our loan portfolios on an ongoing basis. And as the economy changes, so can risk in our loan portfolio. And there may be a belief that a certain sector of your loan portfolio is high risk, and human nature may lead us to assume all markets of that sector are high risk. For example, right now we'll talk about hospitality, kind of a hot topic. And we must remember that not every deal across the nation or every borrower in that particular category has the same data to create high risk. So we must look at each deal on an individual basis, and I think that's extremely important because we have had most recently situations where we are looking at hospitality and vetting each deal separately, and there are still some strong deals out there. So by centralizing the loan screening activity, this can help mitigate the misallocation and misperception of the default risk. Credit decision making needs to be on a case-by-case basis. We need to learn from past experience so that we make good credit decisions. But the past, although there may be similarities, it's not always the same, and that's exactly what we're experiencing right now. We need to be careful that we do not use only objective measurements to ascertain risk. There are times when the objective measurements alone do not tell the full story, and the need to use expert judgment of subjective factors to determine if we should lend to a borrower or not. So we do need to look at the whole picture, and I really do appreciate all the information that was shared here today, and extremely relevant. You've been very, very impressive panel. I appreciate being able to be here with you today. The comment about compensation in regard to performance, that does need to be considered, because if your compensation is based on production, of course that production alone can skew the compensation, and you don't want to do that. You want to make sure that you have more criteria in your compensation measurement than just production, because that is never a good thing. So from a community bank standpoint, I think community banks do a fantastic job for our economy, the United States, our customers, and I know we'll be talking a little bit more about it, but I really want to make sure community banks remain relevant well into the future, because there is a very big need. And I know, Jeff, in your remarks, you presented some statistics that are very accurate. And when I experience those things every day, who does a customer or somebody in your community come to when a need arises? It's the community banks. And so when they are looking to raise dollars or they have an issue, their first stop is community banks. And so we have set ourselves apart. I think we need to continue to foster the relationships that we have with everyone in the room to make sure that community banks remain relevant and strong well into the future. So I appreciate your time today.